Global oil prices are slipping as new trade tensions between the US and EU spark fears of weaker fuel demand. Analysts say the standoff could drag down energy markets and slow cross-Atlantic shipments. Watch the full video to see what's driving the drop, how markets are reacting, and what this means for global fuel prices.
Have you ever noticed how sometimes the smallest shifts you hear about in the global economy, they can hint at these massive, underlying forces at play? One day you see a headline maybe about trade disputes. The next day it's something about currency fluctuations. And then, almost subtly, the price at the gas pump or maybe the cost of shipping goods, it seems to have shifted just a little bit. It can feel like these huge global dynamics are just completely disconnected from our daily lives, right? But what if those seemingly tiny movements are actually direct pulse checks on the world economy? Today, we're diving deep into exactly that, the recent pretty critical fluctuations in global oil prices. And we're not talking about, wild $50 swings here. I mean, those seemingly modest shifts that actually, when you unpack them, they reveal this really complex tapestry of global economics. We'll focus on the key benchmark you hear about, Brent Crude, that's kind of the global standard, and West Texas Intermediate, or WTI, which is more focused on the North American market. And the central question we're trying to untangle is this: what seemingly disparate, often kind of counteracting forces are influencing these absolutely crucial global commodities right now? And importantly, what does it really mean for you, for the wider economy, and maybe for how you understand this interconnected world we live in?
That connection you just mentioned, that's exactly where the real fascination lies, I think. Our mission with this deep dive is really to get beyond just reporting, oil fell 24 cents. We want to peel back those layers. We aim to reveal the intricate, sometimes strategic interplay of global economic health, complex international trade relations, and also these carefully considered supply decisions made by some of the world's biggest players. It's definitely not just about the price per barrel. It's about seeing that even these small price movements are, incredibly potent indicators, signals of much larger, often hidden economic currents flowing just beneath the surface. And for our guide today, we're looking at a really insightful piece of analysis detailing the immediate dynamics shaping the oil market right now. It helps us uncover these multifaceted layers.
And when you say immediate dynamics, you really mean it, don't you? Our source gives us this very precise snapshot. It's almost like a financial seismograph reading. It tells us that Brent Crude, that key global benchmark, recently saw a slight dip, fell 24 cents, settled at $68.97 barrel. And its U.S. counterpart, WTI, also eased back a bit, dropping to 66.99 cents. Now, look, for many of us, hearing 24 cents might not set off alarm bells, right? It's not a dollar swing, certainly not $5. But in the massive world of global commodities, where literally billions of barrels are traded daily and margins can be incredibly thin, these are actually far from insignificant movements. They're more like subtle vibrations, maybe, hinting at larger, perhaps more profound tectonic shifts happening underneath the market surface.
Exactly. Those numbers, while they seem modest on their own, they become remarkably telling once we connect them to the bigger picture. Our source specifically points out that despite these small drops, prices have largely remained range-bound. Now, that's a term we shouldn't just gloss over. It's incredibly insightful. It doesn't mean stagnation or that nothing's happening. Actually, it implies quite the opposite. Being range-bound tells us there's this persistent, intense tug-of-war going on. Prices are constantly moving, oscillating, but within a defined, relatively narrow corridor. It's not a free fall that would signal, a total collapse in demand or maybe an overwhelming flood of supply. And it's not a surging rally either, which would point to crazy demand or severe supply shortages. Instead, what we're seeing is this continuous dynamic push and pull. You could almost imagine it like a very taut rubber band being stretched really forcefully in two opposing directions. One side is pulling down hard, trying relentlessly to lower the price, but the other side is providing an equally strong counterforce, pulling up, offering support, trying to keep prices from falling further. The rubber band isn't snapping. That'd be a market crash. And it's not going slack either. That would mean no one really knows what to do. It's just under constant visible tension. And this implies a very real underlying volatility that's still there, even though the surface looks relatively stable or confined. For market participants, investors, big companies, even entire national economies, this range-bound state signifies an ongoing period of, profound uncertainty. Everyone's kind of holding their breath, waiting to see which fundamental force will eventually win out, because any sustained move outside this established range would have truly far-reaching implications. It's a dynamic equilibrium, yes, but one that's absolutely fraught with tension. It reflects a market that's highly reactive to multiple, often conflicting signals all at once.
Okay, so that takes us right to the really compelling question, doesn't it? What are these forces pulling on that rubber band? Because if prices are stuck in this range, it means there must be genuinely powerful factors pushing them down and maybe surprisingly equally powerful ones preventing a total slide. So let's start by digging into what our source identifies as one of the main downward pressures. And this is where it gets really interesting. Escalating US-EU tariffs. This isn't just some, abstract political debate happening in closed rooms. It's a major, tangible concern for investors that translates directly into real-world economic impacts, and pretty quickly, too.
Yeah, and this immediately raises a crucial question for our deep dives. How exactly do tariffs, especially between such huge economic blocs like the US and the EU, directly impact global oil demand? It might not be immediately obvious, but it sets off a very distinct, almost predictable chain reaction that ripples right through the global economy. So to be clear, tariffs are basically taxes, right? Duties imposed on goods that are imported or exported. When the US and the EU, two of the world's largest trading partners, start slapping these duties on each other's products, it just makes those goods inherently more expensive.
Yeah.
For instance, if the US puts a tariff on European car parts, those parts suddenly cost more for American car manufacturers. And conversely, if the EU tariffs American agricultural products, say soybeans, then those products become costlier for European consumers and food companies. Now, this increase in cost isn't just an annoyance. It acts as a significant, deliberate barrier to trade. It slows things down. Businesses that depend on these imported or exported goods suddenly face higher operating expenses, or maybe their products become less competitive in key foreign markets. This almost immediately leads to a reduction in how much stuff is actually traded. Companies might scale back their orders, they might delay critical investments, or even try to find alternative suppliers, though that might be less efficient or even more costly in other ways.
So it creates friction.
Exactly. And this shift, or even just the threat of it, creates this pervasive sense of uncertainty. And that impacts overall economic activity. When costs go up and trade volumes shrink, businesses inevitably become more cautious. It's natural. They invest less in expanding, maybe slow down hiring, might even consider layoffs. They often postpone R&D. And this climate of uncertainty, this slowdown in business activity, it then filters down to us, to consumers. If businesses are struggling or just uncertain about the future, job security feels less stable, right? Wage growth might slow down, and people naturally become more hesitant to spend, especially on big ticket items like cars or holidays or even just discretionary stuff. The cumulative effect of all this is a measurable slowdown in overall economic growth.
Yeah.
It's like the global purse strings are tightening.
Okay, so that explains the economic slowdown part. But how does that then directly link to dampened oil demand? Where's the connection?
The correlation there is incredibly direct and pervasive. Think about it. When manufacturing activity slows down, maybe because of reduced trade or those higher input costs from tariffs, factories just operate at lower capacities. That translates directly into consuming less industrial energy. And a significant chunk of that energy comes from oil or oil-based products. Think of massive industrial machinery running, the heating needed for huge facilities, the power generation for assembly lines. It's all directly tied to industrial output.
Right, less making stuff means less energy needed.
Precisely. And less trade also means fewer goods needing to be shipped across oceans and continents. Fewer of those enormous cargo ships means a substantial cut in demand for bunker fuel, that heavy fuel oil they run on. Fewer trucks on the roads, moving goods from ports to warehouses and then to shops, means a corresponding drop in demand for diesel fuel. And even things like reduced consumer spending and less business travel can lead to a noticeable decrease in air travel. That hits jet fuel demand directly. Fewer cars on the road for commutes or holidays impacts gasoline consumption too. It really is like a complex, expanding ripple effect, almost like a chain of dominoes. You drop this seemingly localized stone, the tariffs between major economies, into the global pond of trade relations. The first splash creates these distinct ripples. Higher costs, lower trade volumes. Then these ripples expand outwards, inevitably slowing down broader economic activity across continents. And as these ever-widening waves finally reach the distant shores of the energy markets, they show up directly as dampened oil demand across basically every major sector: manufacturing, shipping, aviation, road transport. And what's particularly significant here, I think, is that the market's fear isn't just about what tariffs are doing right now. It's also about what they could do if they escalate further. Could they push the whole global economy into a more significant slowdown, maybe even a recession? That prospect alone is powerful enough to make investors nervous. They pull back, they reduce their forecast for future energy use, and that sends oil prices lower, often even before the full tangible impact of the tariffs is really felt everywhere.
Wow.
Yeah, it's a powerful testament to how market sentiment, just the feeling about the future, can drive real-world prices right now.
That explanation of the ripple effect, and especially that point about investor sentiment driving things, yeah, that really highlights how incredibly interconnected these seemingly separate parts of the global economy truly are. It's not just about the raw numbers, it's about anticipation, about fear. But okay, here's where the plot thickens, doesn't it? Because our source also points out this fascinating counterbalance to these pretty significant trade fears. Despite all that downward pressure, all that concern about global demand, it explicitly notes that the weaker U.S. dollar offered some cushion.
Now, that feels almost like a curveball the market's throwing us. How could a weaker dollar actually help oil prices? Or at least stop them falling off a cliff when everything else seems to be pushing them down so hard? That's a crucial question, absolutely. And it really spotlights the often underappreciated yet profoundly significant role currency plays in global commodities. You see, oil, much like gold and many other major global commodities, is primarily traded and priced in U.S. dollars. That's the standard on the international market. This isn't just arbitrary, it's a historical convention. It's rooted in the dollar's long-standing status as the world's main reserve currency. It offers, stability, liquidity, and it's just universally accepted for global transactions. So whether you're a buyer in Europe, a refiner somewhere in Asia, or a big trading house in the Middle East, if you want to buy a barrel of crude oil internationally, you're almost certainly paying for it in U.S. dollars.
Okay, got it. Dollar is king for oil trades.
Exactly. And this dollar denomination creates a direct and inverse relationship between the value of the U.S. dollar and the effective price of oil for anyone holding other currencies. Let's look a bit deeper at how this mechanism works. When the U.S. dollar weakens against other major currencies, let's say against the euro or the Japanese yen, it essentially means that it takes fewer euros or yen to buy one U.S. dollar. Makes sense.
Yeah, weaker dollar means my euro buys more dollars.
Precisely. Consequently, because oil is priced in dollars, those European or Japanese buyers can now purchase more barrels of oil for the same amount of their local currency. Let's use a quick example. Imagine a barrel of oil is priced at $70. If the euro strengthens, say it goes from buying $1.10 to buying $1.15, then each euro buys more dollars. So that $70 barrel of oil suddenly becomes cheaper in euro terms for a European buyer. They need fewer euros to get those $70. Conversely, of course, if the euro were to weaken against the dollar, that same $70 barrel effectively becomes more expensive for them. So in the scenario our source describes, the US dollar was weaker. This depreciation makes oil relatively cheaper, more attractive for buyers outside the United States. And this improved affordability can show up in one of two main ways. It could actually stimulate some new demand by making purchases more appealing, or, and this seems more likely the case here given the trade tension fears, it can simply prevent prices from falling even further than they would have otherwise. In essence, it acts as this critical shock absorber, a cushion, just like the source says.
It directly mitigates some of that intense downward pressure coming from the economic slowdown fears.
Okay, so it's like a brake on the fall.
Exactly. It's like a subtle but powerful financial force, preventing a really rapid and severe decline. And just to illustrate this effect even more, think about the opposite scenario. What if the dollar had been stronger instead of weaker? If the dollar had been robust, appreciating, oil would have simultaneously become more expensive for all those international buyers. That would have piled on top of the existing demand concerns from the US-EU trade tensions. It almost certainly would have led to much more severe, much faster price drops.
Right, a double whammy downwards.
Precisely. So the weaker dollar, in this case, didn't necessarily reverse the overall negative sentiment or magically cause prices to shoot up. Instead, it played this crucial role by acting as a significant floor, absorbing a substantial chunk of that negative momentum and preventing a much steeper fall. It really highlights the dollar's subtle but incredibly significant influence on global commodity markets. It's a powerful reminder that even when we're focused on oil, we are simultaneously and inextricably talking about global currency values. They are just intrinsically linked in shaping the real-time dynamics of energy prices.
It's truly remarkable, isn't it, how these different layers, global finance, macroeconomics, they just intertwine and interact. It's like this complex, unseen dance. Okay, so we've pinpointed the downward pull from trade tensions. We've got the subtle yet crucial cushioning effect from a weaker dollar. Now, let's peel back another layer, because the other huge piece of this pricing puzzle comes from the supply side, specifically from the actions of OPEC plus Hoge. Our source explicitly states that rising output from OPEC plus, especially Saudi Arabia and tariff fears, kept prices range-bound. So this. introduces a third major factor in our price tug-of-war, a powerful force coming directly from the producers themselves.
Yeah, and this immediately brings us to a really fascinating and crucial question. Why? Why would OPEC plus this really influential group of oil-producing nations actively choose to increase its output when there are already these significant demand concerns hanging over the market because of trade tensions? I mean, on the surface, it seems almost counterintuitive, right? Like a move against their own immediate financial interests. But it is, in fact, almost certainly a deeply strategic decision. There are likely multiple layers to their reasoning. First, let's just nail down the fundamental economics here. When supply increases in a market where demand is already looking shaky or uncertain, it almost invariably puts downward pressure on prices. That's just the basic law of supply and demand, simple as that. If there's more of something available and fewer buyers or less urgent need for it, sellers naturally have to compete harder. Often that means lowering prices to shift their product and make sales.
Basic Economics 101.
Exactly. Now, OPEC plus O, which as you know stands for the Organization of the Petroleum Exporting Countries, plus a group of other big producers like Russia, they play an absolutely monumental role in the global oil market, often decisive. Together, they control a huge chunk, often the majority, of the world's crude oil supply. Their collective decisions on production levels can, and frequently do, swing global prices dramatically. They function, essentially, as a cartel. Theoretically, they coordinate output to stabilize the market, but let's be honest, always with a keen eye towards maximizing their collective revenues and, crucially, maintaining their market share over the long term. And within this powerful group, Saudi Arabia holds a particularly pivotal position, often disproportionate power, really. It's frequently called the quintessential swing producer. And that's not just a fancy title. It means Saudi Arabia possesses the largest amount of spare production capacity in the world. Easily accessible, ready-to-go capacity.
Meaning they can turn the taps on or off relatively quickly.
Exactly. This unique ability allows them to rapidly and significantly increase or decrease their output, either in response to market conditions or, critically, in response to their own strategic goals and geopolitical objectives. This extraordinary flexibility gives Saudi Arabia immense power, not just over global supply, but by extension over market stability and price direction. So their decision to increase output, as noted in our source, is never just a minor detail. It's a highly deliberate strategic choice. It sends a clear and potent signal to the entire market. Now, the implications of this rising output from OPEC plus wine, and especially from Saudi Arabia, are really multifaceted, complex stuff. On one hand, it could absolutely be a strategic play to maintain or even grab more market share. Think about it. If other producers are struggling, maybe because prices are lower, or if there's a perception that non-OPEC plus supply, like U.S. shale oil, which often has higher production costs, might be squeezed, then increasing output could be a calculated move, secure their long-term position, maybe push out some competitors.
We've seen them do that before, haven't we? Like back in 2014-16 against shale.
Precisely. That's a classic example. So history suggests this is definitely in their playbook. On the other hand, it could also reflect their own internal read on future demand.
Yeah.
Perhaps they're actually more optimistic than the broader market. Maybe they think that despite the immediate tariff worries, global demand will ultimately stay strong enough to soak up the extra supply without causing a price crash. Or it could be simpler. Maybe just a strategy to capitalize on perceived current demand levels. Make sure revenues are optimized, national budgets are met, even if it means keeping prices within a certain range rather than letting them soar. Whatever the specific, often opaque internal motivations driving these decisions, the undeniable effect is that this extra supply contributes directly to keeping prices range-bound, as we've been discussing. It adds more oil to a market that's already worried about demand potentially shrinking. That creates additional downward pressure. This pressure counteracts some of the upward forces, like the weaker dollar we talked about, or maybe it just deepens the existing price struggles. Let's try another analogy. Imagine a bathtub again. The water level is the global oil price. Demand concerns, like those US-EU trade tensions, are like a slow, steady leak trying to lower the water level. Now, if OPEC Plus decides to increase output, that's exactly like someone turning on the tap a little bit more, even while that leak is actively draining water.
Oh, okay. So it complicates things.
Right. It significantly complicates any effort to lower the water level overall. It helps keep it relatively stable, or maybe just draining very slowly, despite the leak. It injects more supply into an environment that's already signaling potential oversupply because of slowing demand fears. So it acts as a fundamental brake on any significant upward price movement. This deliberate adding of supply against that backdrop of demand uncertainty is a really crucial piece in understanding why prices are stuck in this narrow, tension-filled range. It's a strategic decision that tells us a lot about their market outlook and their priorities.
That bathtub analogy really makes the supply side impact clear, doesn't it? It's not just about how much water is draining out. It's also about how much is still flowing in. Okay, so let's try and tie all these different threads together now. What does it all mean when you put these seemingly conflicting forces side by side? You've got significant trade tensions hitting global demand, you've got a weaker US dollar offering a surprising cushion, and then you have rising OPEC plus output adding more supply. How do they all combine to result in prices being range-bound instead of, collapsing or skyrocketing? It's a truly fascinating, intricate puzzle.
Indeed, it really is a delicate balance. And that's precisely where the fascination lies, I think, in understanding this dynamic equilibrium that these powerful, often opposing forces create in the global oil market. What we're seeing is essentially a classic tug-of-war playing out on a massive global scale. But instead of one side clearly winning, both sides are so evenly matched right now and so responsive to each other that the rope itself, which is the global oil price, just keeps oscillating, persistently moving back and forth within this relatively narrow stretch. So on one side of the rope, you have that palpable, significant downward pressure that comes mainly from the escalating US-EU trade tensions. And like we said, this isn't just political talk. It translates directly into very real fears of slower global economic activity. When businesses, investors, consumers anticipate higher costs, less trade, more uncertainty, they naturally pull back. That means less manufacturing, fewer goods being shipped, a general cutback in fuel use for industry, transport, travel. This fear of dampened demand, fueled by uncertainty about where global trade and economic growth are heading, is a powerful sentiment-driven force pushing oil prices lower. It's the market basically betting on a slower future.
The pessimist pulling down.
You could say that. But then this strong downward pull is being counterbalanced by two key factors, almost working together. Firstly, there's the weaker US dollar. As we discussed, since oil is priced in dollars globally, a weaker dollar automatically makes oil effectively cheaper for buyers using other currencies. Now, this isn't necessarily creating brand new booming demand in an economy that's already slowing. But critically, it makes the demand that is there more affordable. And crucially, it prevents prices from falling as sharply as they otherwise might. It acts like that financial shock absorber, soaking up and mitigating a big chunk of the negative impact from those demand fears. Without that weaker dollar, those demand fears would likely hit much harder, leading to a steeper, maybe more painful price decline. It's a subtle but powerful economic force providing support.
The currency cushion.
Exactly. And secondly, balancing things out, we have that strategic decision by OPEC plus, but particularly Saudi Arabia, to increase their output. This is a deliberate, substantial addition of supply into the global market. Now, in a situation where demand is already the main worry, adding more supply would normally, in isolation, push prices down even further.
Right. More supply, lower price.
Usually. But when you combine it with the other factors, especially that weaker dollar providing support, this added supply actually acts as another significant force that helps define and maintain the range. It means that while there's genuine demand weakness and concern out there, there's also a clear willingness from some of the world's biggest producers to keep the oil flowing. Their reasons might be complex, as we touched on. Maybe maintaining market share against competitors like U.S. shale, maybe hitting specific revenue targets for their national budgets, or maybe they just have their own more optimistic demand forecasts that differ from the general market mood. And we shouldn't forget the political calculations for each OPEC plus nation are hugely significant too. Sometimes maintaining stability or even influencing geopolitical relationships can be more important than maximizing profit in the short term. So the end result of these powerful, often opposing forces, the downward pull from trade fears and rising supply versus the upward cushion from a weaker dollar, is this fascinating dynamic equilibrium. Prices don't surge because those demand concerns are undeniably real, and global supply remains adequate, maybe even abundant. But conversely, they don't collapse either, because the weaker dollar makes oil more attractive to a huge part of the international market, and there's still a robust underlying baseline demand for oil, even if the growth rate is slowing down. These multiple significant inputs are constantly reacting to each other all at the same time, causing prices to fluctuate within this narrow band. It's definitely a state of tension, not stagnation. The market is very much alive, very responsive, but it's currently locked in this delicate, almost agonizing struggle for direction. So why should you, our listener, care about a few cents movement here or there at oil prices, especially if they seem kind of stuck in a range? Because these seemingly small fluctuations are, in fact, incredibly important early indicators, signals about global economic health and stability. Oil is often called the lifeblood of the global economy, and for a very tangible reason. Its price impacts practically everything in our modern world. Higher oil prices. They translate directly to higher costs for transportation, for manufacturing, and ultimately for nearly every single good you purchase, from your groceries to your electronics.
Yeah, you feel it everywhere.
You do. And lower oil prices, conversely, can ease some of those cost pressures, potentially putting more money back in your pocket or giving businesses a bit more breathing room to invest or innovate. Understanding these intricate dynamics really empowers you, I think. It helps you become a much more informed observer of global events. So next time you hear news about trade disputes between, say, the U.S. and China, or the U.S. and Europe, or you look at currency exchange rates, or you see reports from those important OPEC Plus meetings, you start to connect those dots directly to the energy markets. And then crucially from there, to broader economic trends that directly affect your daily life, your investments, the wider financial landscape. This knowledge lets you see beyond just the headlines. It helps you grasp the underlying mechanisms at play, maybe even anticipate potential impacts before they become front-page news, which raises an important question for you to think about. In a market that's balanced this finely, where these major forces are locked in this constant push and pull, what single factor, in your opinion, holds the greatest potential to finally tip the scales? To break this range-bound reality, either decisively upwards or dramatically downwards. Is it maybe a major breakthrough in trade talks? Or perhaps a sudden currency shock? Or could it be a geopolitical event somewhere unexpected?
That's a really profound question, and it perfectly captures the core of this deep dive, doesn't it? We've shown how specific oil price movements, like Brent Crude's 24-cent dip or WTI falling below $67, they're far from just random numbers. They are direct, measurable responses to this deeply complex interplay of global forces. We've carefully unpacked how escalating U.S.-EU trade tensions act as a significant downward force, dampening fuel demand by casting this chill over economic activity, manufacturing, global shipping, travel. We've also highlighted that subtle but absolutely crucial counter effect from a weaker U.S. dollar, how it makes dollar-priced oil more affordable internationally, providing that vital cushion against even sharper price falls. And finally, we explored the significant impact of rising supply from OPEC Plus cereal, especially Saudi Arabia, injecting more oil into a market that's already worried about future demand, contributing to that feeling of potential oversupply. All these factors, acting together, often pulling in opposite directions, are what keep prices in that fascinating range-bound state. It's effectively acting as this sensitive barometer, showing us the underlying tensions and, importantly, maybe the resilience of the global economy right now. It's a constant dynamic negotiation, isn't it? Between supply, demand, complex trade policy, shifting currency strength, all battling it out for dominance.
And if we connect this to the really big picture, just consider this for a moment. Given that these major geopolitical forces, these huge economic factors, are locked in such a delicate, persistent struggle over oil prices, what does that truly tell you? Does this speak to the underlying fragility of the global economy right now? Or maybe it's surprising resilience? Are we actually in a fundamentally robust state, just experiencing some friction, some adjustment? Or is this range-bound behavior perhaps a subtle warning sign? A sign of deeper, unresolved vulnerabilities that could, maybe with the right trigger, unravel quite quickly? And perhaps even more critically, what other major global events, things not explicitly mentioned in our sources today, but potentially just as powerful, could shift this delicate balance? Think about things like unexpected technological breakthroughs, maybe in energy production or even energy consumption, or sudden, unforeseen geopolitical shocks in a major oil-producing region, or even profound shifts in global consumer behavior, maybe driven by climate concerns on a massive scale. Any of those could fundamentally shift this balance in an instant. The oil market, despite its current appearance of equilibrium, is always just one major unexpected event away from breaking its current pattern. And that would send ripples of impact far, far beyond just the energy sector itself.
Absolutely. The lessons from today's deep dive are, I think, undeniably clear. Global oil prices are so much more than just abstract numbers flickering on a screen. They are the tangible result, the manifestation of this complex, interconnected dance between high-stakes trade policy, constantly shifting currency values, and the strategic supply decisions made by powerful nations and groups. So as you go about your day, maybe keep a keen eye on these specific indicators. We've talked about trade news involving the big economic blocks, currency movements, especially the U.S. dollar's value, and of course, any announcements from OPEC Plus about their production levels, because these will continue to be the primary drivers shaping not just the global energy landscape, but by direct extension, the world economy that impacts every single one
In
of
Global
us.
Mind News. If you found this report helpful, make sure to like, share, and subscribe. We bring you the facts, insights, and updates that matter, straight from the source. See you in the next report.